Hello, everyone. Welcome to this month's live Realosophy Move Smartly market update for Toronto's housing market. Thank you again for joining. Again, I like hosting these sessions. Once a month, give us an opportunity to kind of go over some of the key trends I'm seeing in the housing market. So on that note, I'm just going to walk through some of the things that we're going to be chatting about this month. Just a quick update on the housing market, some of the stats and trends I'm seeing on the ground, and of course, obviously, some data to back that up. So we'll look at that, and I'm going to chat a little bit about pre-construction real estate, just very briefly, some things that I've been seeing online that I think are not great, not very professional, that people should be very cautious of. And of course, I'm going to have, as we usually have, David Larocque, mortgage broker, to join us to chat a little bit about some of the latest trends in the mortgage and interest rate market. As always, if you have any specific questions, we're going to have Urmi's joining us today from Move Smartly, looking at your questions. If you have more specific questions, you can always set up a meeting with me, movesmartly.com/meetjohn for kind of a more personalized buying, selling consultation. Otherwise, if you have more general questions, feel free to post them in the chat, and we'll be answering those as we go through today's discussion and presentation. So I'm going to kick things off with a little bit of an update on the market for low-rise homes. And I'm actually going to start with detached specifically. Detached is the biggest segment of the low-rise market. The other two house types being semis and row homes, but detached are certainly the biggest. And when we look at sales for the month of March, going back to the year 2000, last month, 2023 March, we had about 3,000 home sales for that given month. Which is well below a historical average. It's somewhat similar and in line with sales volumes in 2018 and 2019. Those years were quite slow because we had just come off the bubble. The mortgage stress test on uninsured mortgages had been introduced, so the market was taking a little bit of time to rebound. So we're sales are still low historically, but in line with 2018, 2019, and just below 2020 as well. But the more interesting trends when we start looking at the data is new listings volumes. I mean, this is where we're seeing the biggest problem. I mean, we typically see around last month, I should say in March, we saw 4,400 detached homes hit the market for sale, which is unbelievably low. I mean, if we look at the historical average for the month of March back to 2000, we typically see about 8,400 new listings. I mean, and this includes some of the peak periods of 2021, but a common volume is about 7,500. So we're well below that at just 4,400 new listings for detached homes. And this is really one of the big factors that is putting pressure on the housing market, that we're not getting a ton of inventory. And we look at the number of active homes for sale, is again unbelievably low. I mean, when we look at that, it's about about 4,400. So 4,400 is the active listings. I made a mistake with the new listings last month. But yeah, active listings, again, very soft, well below the historical average. And the thing is, I mean, we're kind of very similar to last year's 2021, 22, or just below that. But those were periods where we saw a ton of new listings and a ton of sales kind of basically buy up all the inventory. And that's why inventory was low in those periods. They're like the bubble period, similar with 2016, 2017. Right now, inventory isn't so low because we have a lot of listings and a ton of demand buying them up. We have a few listings because very few properties are hitting the market. So when we look at the balance between demand and supply, which we call sort of the months of inventory, which is just basically the number of homes available for sale divided by the number of homes that have sold in the past month, we can see that this has been plummeting since the start of the year. And we have just over 1 month of inventory, which is a very, very tight seller's market. And what has happened over the past couple of months is that we're starting to see prices for low-rise homes actually trend up, which is surprising. I mean, I didn't think we would see this. I thought we would probably at least have flat prices over the next, 6 to 12 months. But what happened is, prices have been flat pretty much at around 1.3 million since around July. And over the past 2 months, they've been trending up. So we're just under 1.4 now. The average price for a low-rise home is about 1.38 million. And again, on the ground, I mean, what this looks like is just a very competitive market. Most homes are getting multiple offers, over 50% of them are. And that's just not just because, agents are pricing them low. That's just because there's just so much demand. And anything that is priced well without an offer date is selling quickly, even in the high-end market. I mean, we had clients looking at homes like in the 4 million price range. As soon as it hits the market, they got an offer the next day because it was priced well. So, even in the higher end price point, things are moving relatively quickly if they're priced well. So that's a little bit about the market for low-rise homes. And again, it's the volume of listings or lack of listings that is really creating this competition. Now, when we look at the condo market, the dynamics are a little bit different. I mean, when we look at condo sales, we are in line again with 2018, 2019 volumes. We had about 2,100 condo sales, well below the peak during the bubble, of course, over the past couple of years. But in line with kind of historical norms, I'd say, and even in line with like the 20+ year average. When we look at the number of new listings for condominiums, even that is in line with historical average. I mean, probably a little bit below sort of the 10-year average. But again, not as unbelievably low as we saw for low-rise and detached homes. And similarly, active listings are above recent trends, since 2017, 2018, 2019. I mean, our active listings numbers are about 3,900, which is well above the past 5 years, but still below the years before that, where we would see closer to 5,000 listings hitting the market. Now, the dynamics in terms of demand and supply, the months of inventory is also trending down for condominiums. So we're just under 2 months of inventory. But the difference between the condo market and the low-rise market is that the condo market, even though inventory is tight, it's not as fiercely competitive. What some of these statistics don't capture is that, inventory can be tight in the condo market, but condos are getting 1 or 2 offers on them. They're selling quickly with 1 bidder or 3 bidders, whereas the market for low-rise houses is far more competitive. We're getting, seeing houses with 5, 10, 15, 20 offers on them. And that's, of course, what's pushing the prices up. So when we look at prices for condominiums, those have not really picked up very much. We've been bouncing around this low 700s range for condominiums. So we haven't seen much upward pressure on prices yet. So that's a little bit about the market for the low-rise homes and for condominiums. I'm going to chat just briefly about pre-con properties, so pre-construction, either low-rise or houses, because I've been seeing a lot of videos and people have been sharing videos with me about real estate agents effectively promising or telling people that this is the best way to build wealth, to just buy pre-construction properties. And I think we have to be very cautious about that. And I'm going to try to unpack some of the challenges and risks with some of the things that these agents are promising, often very new agents who quite frankly either don't understand or aren't communicating the risks to their audience, to their public. And I saw one person talk about how they went from 0 properties to 5 properties in 12 months. Is this possible in the Toronto area? Unless you have a ton of money, it's not. You cannot do this with existing resale homes. It is unbelievably hard to get a mortgage when you're qualifying on your income. So you'd have to have a ton of capital. But what a lot of the people who are promising to sort of build a portfolio of 5 properties usually are doing is actually not buying 5 properties. They're typically putting deposits down on 5 properties and buying 5 pre-construction condos or homes or whatever it is, and maybe partnering up with people. But what they're not saying is this is an unbelievably risky proposition, because what a lot of these people promise that you can do is you just put down your deposit, and then before closing, you just flip it for a big profit. But unfortunately, it's not that simple. And to be frank, some people have done that, but some people are not. When we look at the markets today, I know people who have lost money on pre-construction properties. I mean, one person in particular bought a pre-construction condo for around $850,000, and then when it came time to close, the condo wasn't worth that. It was only worth about $750,000, so like $100,000 less than what he paid for it. And what happens in that situation is it's hard to get a mortgage, because what you have say you have $100,000 in deposits in that property. Well, now you need another $100,000 plus or 150 for the down payment, because all of the money that you put in for your deposits is just burned away, because the value is 100 grand less than what you paid for it. So unless you have a ton of money to kind of cover that difference and have an actual down payment, you can't close on it. And this is some of the challenges that some buyers are finding today. So flipping, again, with that type of property, you can't just flip it, because the value isn't worth what it was originally purchased for. And flipping pre-construction properties is also very challenging, because it's a very illiquid market. You can't advertise them on the MLS. It's very hard to sell. So there's a lot of exposure. If you're now bought 5 properties, you have to be in a position to have the money to close on them. You can't bank your entire future on the expectation that you can just flip them and make easy money, which kind of takes me to, I think, an important point a lot of people needs to understand. It's almost like very fundamental tenets of investing, both in any like equities or in housing. And the first kind of key concept is that yesterday's good investment might be tomorrow's bad investment. Just because someone made money buying a pre-construction property during what was the biggest housing boom in Toronto's history, it doesn't mean you or I or someone else is going to make that a year from now or 2 years from now. The fact is, anyone could have bought any property over the past 3 years, especially resale, and in some cases pre-con, and made money, because the market exploded over the past 2 years. It doesn't mean we're going to see the same returns over the next 5 years. So, again, a lot of the people who are promising these kind of get rich quick, this is how you build wealth, they're kind of missing this point. They're kind of just talking about their story. And yes, I mean, we all made money. Anyone who owns real estate or invested in real estate has made money. I mean, you don't need to be a PhD to do that. The challenge is, can you replicate those and do those in the future? And I think that's one of the things people have to understand, that it may not pay off in the future, and people need to be very cautious. And then the other important tenet I think people need to think about is that, an investment that has a high return, which is what a lot of these people promise with pre-construction properties, is actually a high risk investment. There is no such thing as high risk and low return. Again, if it was that simple, all of Bay Street would be buying up condominiums, because they're in the business of maximizing their capital and their return. The reason they're not is because there's no such thing as a high return investment that is low risk in housing. The thing with housing is, again, if we go back to the story of, if you've bought 5 pre-construction properties and made investments, you're incredibly exposed to potentially downside risk, because again, like in the examples of, if you buy pre-con and the value is worth less than what you paid for it, you're responsible for that difference. So which means that your risk is losing more than just your deposit. Like in a lot of pre-construction properties in the suburbs, people bought homes for $2 million that are now worth $1 million. So it doesn't matter if they only put down a $200,000 deposit, they're responsible for that $500,000 difference in value. And this is what makes real estate, especially pre-construction, different from even investing in equities, where your potential loss is just what you've invested. And that's not the case with real estate. So to expose yourself to that over 5 properties is a very, very risky proposition. And this is how people lose their life savings, and it's not to say that you can't, make money off of that 100%. If the market explodes and prices surge, you could get a high return, but, focusing on the high return without thinking about the high risk that it's involved, I think is unprofessional. So I think people really need to take some of these, people who are trying to promise these get rich quick, or this is the way to build wealth on real estate, just buy lots of pre-construction properties. I think they really need to take it with a grain of salt, because I think many of them are not talking about sort of the potential downside risks. So on that, I'll end that. I don't know if we have any questions, Urmi, before we kind of jump into getting Dave to join today's chat.
Yes. Hi. Thanks, John. I do think we have a good question here. And I think touching on what you're talking about, is this an issue of long-term versus short-term strategies? So Zaid asks, what is the endgame argument for someone who is bullish? And I'm presuming about the pre-con that we're just discussing. If rates come down or government continues to bail out and allow negative amortization, does the chart just continue going up and to the right? So in other words, are these people just thinking prices will always rise? We've heard that before. And maybe you can explain why, even though sometimes over the long run, that might be the expectation, why trying to do this can get you into trouble, along the way, if that makes sense.
Yeah, 100%. I mean, so yeah, if you're bullish, I mean, I think it's, you invest in real estate. I think what the challenge is with these pre-cons that some people are doing is putting 5 deposits down on 5 properties is incredibly risky. And I mean, Dave will join in 2 minutes to answer that as well. You have to have the money to close. And if you don't close, you're defaulting on those purchases. And I think people just don't understand that. And again, I think even it's a very, very speculative bet. And this is why there's the high potential for very high return. You put down 50 grand and after 4 years, that 50 turns into 200 or 150. Well, when you make that type of return or potential of that return, there's also sort of the downside risk. So, if you want to buy real estate, I think you just have to be be in a financial position where you can close on the properties that you're purchasing pre-construction. If you're going pre-construction, that's the problem a lot of people are having now. They never intended to close on them, so they can't get mortgages today, right? And this is the challenge that a lot of people are having is number one. Number two, if you do close, you have to be thinking about the spread between your rental income and your cash flow and your mortgage payments, all those things. So if you're closing in 4 years and your interest rates are 4%, most investment properties don't look great in terms of a cash flow perspective with 20% down, and we hear from people already who are just selling some of them because their cash flow is short, $1,500 a month because their rent's not high enough. And if you actually buy a resale condo today, like a 1-bedroom condo, you're going to be short close to $1,500 a month because your mortgage payment, property taxes, your maintenance fees are going to be way more than the rent that you're earning on it. So, so invest in. I mean, I personally would rather buy a resale property and the difference between resale and people don't understand is that if I buy a resale property today and prices fall, my entire financial wealth is not exposed to that downside risk. If I just hold on to that property and keep making my payments, I can ride out any short-term downturn, right? Whereas with pre-con, if you buy and prices fall before you take possession, you have to have the capital to cover that loss. And if you have to cover the loss, and that's a huge difference. And if you have to cover the loss on 5 properties, you could potentially go broke, right? But I can't go broke if I have 5 properties that I bought resale and I can just manage the cash flow with my rental income. It doesn't matter if prices fell, right? As long as I keep paying my mortgage, I'm fine. And this is the big difference but this is the difference, okay? Resale, if I buy a triplex, my return is potentially not as great because my leverage is lower. It is safer. I have a long-term asset. I have rental income. I have yield. I'm not exposed to all the ups and downs in the market. So over the long horizon or over the 5-year term, my return is probably not as great as if I go high leverage on 5 invest pre-con properties, right? That person has way more potential to like triple their cash, but they're also way more exposed than I would be, for example.
Right. So as an average consumer, non-expert perspective, I think to add to your rules, at first, I think it's important to clarify the reason why the resale is safer. It's not that it's safer, it's that you qualify for the mortgage, you figure out your financing when you are getting those properties. Again, the pre-con, the pitch that a lot of inexperienced or let's say dishonest agents are pitching is you just pay the deposit. And by the time your building's ready and you have to take a mortgage to take possession, your building will have already appreciated. Now, that might be the case in the long term, but I've often heard you say, John, the key to being good at real estate investing is being able to hold.
Mhm.
And I would have to say that even now is a period in which even if you have resale properties, a lot of them, people are getting into trouble because they did not anticipate these really rapid rate hike cycles. And that's why in the long term, you might say, yes, it's sure 5-10 years out, these properties will appreciate. Can you hang on financially?
Yeah.
If you cannot make your payments, whether it's to honor the contract of a pre-con or even coming up with your monthly mortgage payments amidst really intense high rate rises, you lose what you put in, your house gets sold off, you do not own it.
Yeah.
And I think a lot of people, are missing that point. So that's the other issue about real estate I've always found interesting. It's like, you got to hold.
Yeah.
It makes it very different than equities in that sense.
100%.
You have to be able to hold. So, and can I be honest, like how many people predicted that we would have such an inflationary cycle coming out of COVID, that it would last this long and cause central banks to raise rates? I didn't see a lot of predictions on that. So it's the short-term blips that you're hearing from consumers getting caught out in, correct? Like
100%.
It's not just reckless people always. It's just,
no, it's not reckless. It's listen, and I don't think the people making the investments are reckless. Like I feel these are the people I feel the worst for, because they're listening to people who are acting like experts, and they're taking the advice of people who are not kind of advising them on the risks. So I feel bad for them. But honestly, go to Reddit and you'll see like hundreds of people distressed and having problems. They can't close on their pre-con. They don't know what they're going to do. Like, just look at the stories, and you have to think to yourself, how do I avoid being those people tomorrow? Right.
Yeah. So, because they're selling them. And
Exactly.
we've seen this even with financial investments. Somebody sells you an amazing fund and they forget to tell you, if you stop making your payments, you lose all the money you put in. Has anyone else bought one of those? Yeah. So I was very young in my defense. And I have a lot of sympathy for people who think they've got to make some cash quickly because the runaway house prices is the greater context.
Yeah.
So, that does leave people vulnerable. So I hope that answers Zaid's question. And I think we're on to our next segment.
So let's get Dave. I mean, before we chat about rates, Dave, I don't know, maybe if you have any insight to add on this whole pre-con thing. I don't know if you've had clients who are in the position of closing on pre-cons, or any challenges you've seen on your end.
I don't run into it a lot, John, but I certainly hear about it anecdotally. And, I agree. Some people are getting burned and it's sad. And there are people who are just trying to buy a place to live in, who are just facing a lot higher borrowing costs than they were banking on. I'm a little less sympathetic to the speculative element. It's not, in my opinion, a big chunk of the market, but the bottom line is there was about a 10-12 year period where you could make a bunch of deposits on condos you had no intention of closing on, and you could sell them on assignment and pocket the cash. And it worked for a while, but just because it works doesn't mean it won't work someday. And those people were very aggressive, and they took. I mean, it was crazy. I mean, a friend of a friend was bragging about it. I remember thinking, I'm sure you feel like you're really smart because it's working now, but but it might not work forever, and it could work for a long time and then blow up in your face, and you could lose more than all that you made leading up to that. And the guy looked at me like I was stupid. It was just inconceivable to him. It was inconceivable to him that the market, could be any different than the way it had been. And in his defense, it lasted for a long time, but markets can change. And this is a reminder, when rates are really low, people take on more risk. To Urmi's point, some people have to chase yield. They can't get decent returns unless they take on more risk. And part of what we're seeing in the market now with the Silicon Valley bank collapse and First Republic Bank and the weakness out of Credit Suisse in Europe, as Warren Buffett says, when the tide goes out, we find out who's swimming without swim trunks on. And these cracks that we're seeing, the fact that things are breaking is in many ways a healthy sign. I use the example of a forest fire where when you have natural forest fires, they don't get too big because every few years the dead wood clears out. But the central banks have been stepping in and stopping the market from correcting during 2008 when the US financial crisis happened. We saw it during COVID. In Canada, we had an oil price crash in 2015, which the Bank of Canada bent over backwards to accommodate with rate cuts. And a lot of that dead wood in the economy built up. And now we're facing a danger where if we don't have these corrections, and if there isn't pain across the economy, I don't want to sound unsympathetic, these are people's lives we're talking about, but from an economic standpoint, not letting these things play out, when raising rates and letting these things play out just risks a bigger, more uncontrollable fire down the road. So there really is no better option. And I think that's what the Bank of Canada has said. And if people have speculated in the past and won, they're learning now that it doesn't work forever.
Yeah. So speaking of the bank, maybe we'll touch on, I mean, they held rates, of course. And what do you think, or what do you see as sort of the outlook over the next, 6+ months for rates? Both the Bank of Canada and potentially bond yields, and how that might impact longer term rates in the second half of this year.
Sure. It's interesting, John, because the bond market and the Bank of Canada and the Fed still don't agree on what the future is going to look like. The bond market is pricing in rate cuts by the end of this year. And Bank of Canada Governor Tiff Macklem, in his most interesting comment when he gave his press conference, was that the implied expectation in the market, i.e. rate cuts, that we're going to be cutting later this year, does not look like the most likely scenario to us. And that's they're very polite and cautious when they say things like that. That's about as close to he'll come to saying market doesn't have it right. We aren't cutting rates. They need inflation to come down. They need it to come all the way down to 10%. They have pointed out
not 2%, not 10%.
Oh, I'm sorry. 2%. Pardon me. Yeah. No, if they needed a 10%, we're fine. They should be cutting already. Thank you, John. No, 2%. We needed to come to 2%, and we're still too high. We're still north of 5%. So at the end of the day, when average wages are rising by 50%, 5%, geez, what's going on with me today, John? When average wages are rising by 5% plus, and productivity levels are falling, you're just not getting back to 2% inflation anytime soon. And most of the inflation we have today is coming from the service sector, where labor is the single largest component of a business's costs. So really, the bank is saying this is going to take longer to sort itself out than the market is pricing in and thinks. The market's saying we don't buy it. But if you're listening to what the guy with his hand on the lever is saying, and again, he told us in 2020 rates weren't going up for a long time and Canadians should go out and borrow lots of money. So understandable that people want to take what he says with a grain of salt, but I don't think they can be wrong twice. I think he knows his credibility is really on the line this time because he got it wrong so obviously and so damagingly in 2020. And again, they're telling anyone who will listen, inflation is going to take longer to come down than the market expects. And they're not cutting until we get to 2% rates. So I continue to believe that rate cuts are going to happen in 2024, and that people will be disappointed if they expect them to happen sooner. Interestingly, bond yields are a different story. And in fact, what's happening with bond yields right now, John, makes me more convinced we're not seeing rate cuts till 2024.
Okay.
Here's the long and short. When the US banking crisis happened and we saw Credit Suisse have tremors in Europe, bond yields plummeted. Everybody started flying into sovereign debt because all of a sudden investors were much less worried about the return on their capital than they were about the return of their capital. They just wanted a safe place to hide. and bond yields went way down. In Canada, the government of Canada bond yields piggyback on US Treasuries, and US Treasuries fell through the floor. And we price our fixed mortgage rates off of government of Canada bond yields. So all of a sudden, the fixed mortgage rates got carried along. Government of Canada bond yields piggybacked on US Treasuries, and government of Canada bond yields took fixed mortgage rates with them lower.
Mhm.
And all of a sudden, the real estate market got all this free stimulus, because with lower fixed mortgage rates, all of a sudden, I'm doing a lot more business. There's a lot more activity in the market. Clearly, this is juicing the real estate market. Now, if you're the Bank of Canada, you said inflation's too high. We need to raise rates to slow the economy. We're getting employment reports that are higher than expected. We're getting jobs reports that are higher than expected. We're getting consumer spending data that's higher than expected. The only part of the economy that was reacting the way the Bank of Canada hoped was the real estate market. We had a slowdown earlier this year as a result of higher rates. But now that we've got this tailwind blowing up from south of the border and fixed rates have fallen, we're actually juicing the real estate market, and real estate activity is picking up. So if you're the Bank of Canada and the only part of the economy that was really being impacted by your rate hikes is now being stimulated by these effects that you can't control, you're much less likely, whatever timeline you had for cutting rates and pausing has to shift. You've got to be saying either we're going to pause for longer, which I think is the most likely scenario. I don't see more hikes yet. They said they were going to pause. It was going to take an accumulation of evidence. Most of the evidence we've seen since then would argue for higher rates. But I don't think they're coming off the sidelines anytime soon. I really think they're going to pause till at least the fall and later into this year. But what's happening with fixed mortgage rates is the opposite of what the Bank of Canada was hoping for. And in one of my recent posts, I made the point, the benefit to fixed mortgage rate borrowers is coming directly at the expense to variable rate mortgage borrowers, because fixed rate borrowers are getting lower fixed rates. But as a result of that, it increases the likelihood that variable rate borrowers are going to have to wait longer to see those rate cuts.
And I mean, what's crazy is, I mean, you're talking about fixed rates being stimulated, and we're still talking about 5-year rates like in the 5% range, right? I mean, which is obviously down from, you know, where they were sort of at the peak, but they're still high. Like it's still, you know, it's still shocking that that the market is still where it is, where the stress test is in the 7% range effectively. So it's a bit shocking that that's going to happen. So do you think over the next second half of this year, we might see even more downward pressure on fixed rates?
It's hard to say, because we won't know until we see how the US banking crisis plays out. There's an old expression that when something happens, when one bank goes down, then more banks will follow. There's the old saw that if you find a cockroach, there's never just one of them.
Yeah.
A lot of the regional banks in the US, the big mistake Silicon Valley Bank made is it bought a ton of US Treasuries, right? It bought US Treasuries at returns of below 2%, with yields of below 2%. The yields went up to 5%. It's not the end of the world as long as you don't have to sell those Treasuries. But when all of your deposit holders start trying to ask for their money back, you've got to sell those Treasuries to honor those redemption requests. And when you sell the Treasuries with yields of 2% and yields are currently at 5%, you sell them at a loss. And when you sell a bunch of them, you sell them at a big loss until you've basically become insolvent. So the irony is, John, the way you solve the banking crisis is not by cutting interest rates. That's second level. That's a secondary benefit. You have to create a lot of liquidity in the market, and you have to guarantee deposits. And the U.S. Treasury did that. And to me, rate cuts, we still got inflation too high. Even if the Fed and the BOC wanted to cut rates, they'd be cutting off their nose to spite their face. So, you know, I don't think that the U.S. banking crisis is going to blow up into something big. I hope those aren't famous last words. But based on what we're seeing right now, things are already normalizing. And if that happens, John, then whatever tailwind we got from bond yields dropping and from fixed rates should slowly work its way out of the market. But again, there's no way to know without being confident about how the US banking stuff is going to play out. And I'm not confident of that yet. I think there's more to come.
That's awesome. That's helpful. Urmi, let me kind of pull you in. I don't know if we have any questions specifically for Dave or myself in our chat.
Sorry, my mouse fingers aren't working very well. I don't think there's anything particular. Oh, there's a question here that you guys will love.
Which one's that?
First Last asks, when will house prices bottom?
Oh,
They bottom, John? I mean, over the short term, haven't they gone up?
they feel like they have. They've gone up. They're trending up. So unless you, okay, at least for low-rise homes, unless you think we're going to hit another crash or decline, I mean, they bottom because prices today are at their highest level, I think, since May or June. So they're trending up again. And again, I think a lot of this is, the bank supporting households by, accommodating their longer amortizations, lower payments. There's not a lot of distress, and the demand's unbelievably strong for housing in Canada. So again, I don't know, it's hard to say what would cause a dramatic turnaround. At the end of the day, when we think about how markets cool, like inventories plummeting, like that is the opposite direction of a crash. Like you need inventory to surge, which happened in 2022, right? Buyers paused, new listings accumulated, and inventory built up and prices fell. So we're not there. So I don't know what's going to cause that. I mean, it's not to say it's not possible. It's possible, maybe more possible in the condo market than the low-rise market, but we're not seeing that yet.
And I invite everybody to look at John's latest report on moosefrontly.com. It has all the figures for home prices. And yes, one of the leading stories was that Toronto house prices are back up. And you can read that there and all the detailed numbers in the report as well. I think that's it for Dave, specific questions.
All right. Beautiful. Then we'll maybe if there's other ones for me, we'll let Dave jump off so we don't keep him on for too long. But thanks again so much, Dave, for joining us. And hopefully you'll be able to join us next month as well.
Okay. Always a pleasure.
Right. Okay.
Thanks, Dave.
Thanks, Dave.
Bye, guys.
Any other real estate specific questions?
Yes, we have quite a few. So looking at, let's start with Preeti's question here. Just looking at the market in general right now on the ground, is holding back offer strategy working in this market, or is it better to just list at the price desired?
Yeah, I'd say it depends on the home. I mean, for most homes, listing low with an offer date has been paying off. People are getting tons of offers, tons of showings. But again, I'd say that's generally for homes that are largely moving condition, that are nice, good condition, kind of turnkey. If the home needs a renovation, is unique, a little bit quirky or whatever, yeah, that's the kind of home that you should be just listing high and waiting for the buyer to show up. And and there are homes like that are just taking offers anytime. They typically need renovation. But if you're a turnkey home, you almost have to, as a seller, like you're doing yourself a disservice if you just list, because people are paying a premium today and more than comparables for really nice houses. So you'd want to take that strategy.
Great. Let's see. I think there's one more specific question. This is about a news story, and I don't really know if you have anything to add on this, John, but we're lucky to be joined by Mr. Potato Head, a celebrity. And he's asking if you have any thoughts on the recent new construction fire. So I think that's the fire in Vaughan that took out, I believe, is it 4 detached homes?
No, it's quite a few detached homes, actually.
Even
I think
more.
it's way more than 4. Yeah. Apparently there are quite a few, a big issue with fire and wind. I mean, I have some thoughts. It seems quite odd. I mean, it could be, who knows what caused it. I think we'll just maybe wait to see kind of what the fire department kind of considers the cause, but it definitely seems, I mean, obviously kind of odd and interesting that just before closing, a lot of these properties kind of catch fire. So I don't know what's behind that. Again, I think, I don't want to get into sort of the rumblings I've heard from people, but obviously some people are kind of talking about, is this Is it arson? Are people like worried about, closing? But again, I wouldn't jump to those conclusions because, you don't know. Some houses in some of the areas that are new builds, people have no problem closing and they want to close and the values have gone up. So just because some homes have had this issue with distress and people protesting and they don't want to close doesn't mean all neighborhoods have that. And I think that's kind of maybe where this question is coming from. So I wouldn't necessarily conclude that. I mean, at the end of the day, a lot of these people bought intending to move into them. That's usually with low-rise homes, and it's unfortunate, obviously, that we saw that happen. So hopefully we'll see what the fire department says is the cause.
Right, because if they're close to closing, then these are people that have bought these units at least 4 or 5 years ago.
Well, no, not necessarily for low rise, because the construction cycle and the pre-construction for low rise is short, but maybe 3 years ago, maybe 2.5 years ago. Yeah. So something like that. They bought a while ago. They didn't buy at the peak a year ago, probably, right? It's very likely that these probably, especially in that area, have gone up in value. I don't know. I haven't looked into them. I don't necessarily fit the definition of the people who are protesting necessarily. Right. I think this is it sounds probably maybe more like some kind of odd construction accident. Who knows?
So we'll have to wait and see. And I just have another question here. Let's see. Let's go back to the question of listings, low-level listings. From Adriano, the question is, John, outside of employment numbers collapsing, what do you think would cause an influx of low-rise listings in the GTA? And so far, we have a lot of bank action to prevent people from not being able to keep up with their payments. Is that something that could run out eventually, or what do you think?
I mean, I don't think that's going to change very much. I don't think banks are going to force people to move out of their homes. They're going to work with them. I think I don't think we're going to see a flood of listings. Like, if anything, we might see them accelerate. I think one of the challenges right now is that, one of the reasons new listings are low is because people aren't upsizing. I mean, one of the sources of new listings sort of in the first-time buyer range is someone moving from their first-time buyer type home to a higher-end home. And we're seeing less of that because upsizing is a luxury today, just based on where interest rates are. It's a lot more expensive. So I don't know what's going to lead to a big influx or a big surge of listings. I mean, hopefully it just picks up to some seasonal norm. I don't think we're going to see a flood of listings, but it's just shocking how low they are right now. I mean, I think everyone's been a little bit surprised. Like, it's, if we looked at the stats for detached homes, I mean, it's off the charts how low new listing inventory for low-rise houses is right now.
And just from my outsider observation, how much do you think this is people who can't upsize right now at these rates? And so they are holding off upsizing, so they can't vacate the listings that would normally go onto the market. Do you think that's a large enough factor to contribute to these low listings?
I think that's definitely one factor that's contributing to it. I don't think it's like just one thing. I think that's one factor. I do think, and I'll look at the data, but I'm pretty sure we're seeing, again, more people who are moving or upsizing if they need to leave, like even leaving the province, not selling their homes. Like, a lot of people who, if they're moving to more affordable markets, if they can, they're keeping their Toronto home as a rental property, right? And this, of course, is a trend we've seen accelerate over the past 4 or 5 years. And what this is doing is it's taking single-family homes, low-rise homes that are tended to be owner-occupied, converting them into investment properties that just end up hitting the rental market. And if we look at the statistics, the rental listings for low-rise homes has exploded over the past 5 years. And this is one of the factors. And you might be thinking, well, how can someone afford to do this? Well, a lot of the people who are doing this bought their homes 15 years ago. They have so much capital in them. They have a home that's worth like 1.5 today that they bought for 500 grand 15 years ago. So in many cases, they paid off that mortgage. They have a ton of capital, and they can even afford to take 750 grand out to buy their Maritime home or their Calgary home and still keep their property as an investment property.
Do we call that arbitrage? What do we call that? I don't know.
That's just hoarding and holding on to real estate.
Just hoarding. Okay, so I'm going to just choose one last question here. Again, keep your questions coming. They can be answered in future live updates as well. Let's end with Baltage's question, at least on the market. Questions are welcome on the next segment as well. I take that the data and the emotion on the ground just don't match up. What do you think about that? Because looking at your latest report, it does look like some of the short-term data trends are matching the behaviors of people in the market. So they're seeing prices hold up and in certain segments, especially houses, and now they're not as afraid to bid and really go for putting multiple offers on houses and things like that.
Yeah, no, 100%. I think the data and the emotion are 100% lining up. When we look at the market right now, I mean, what's interesting is I saw someone tweet out that or argue that realtors create the FOMO in the housing market, like the fear of missing out, which is ridiculous. I mean, when we think about the emotion in the market, the fear of missing out is caused by the fact that every nice home that hits the market has 10 people bidding on it. Okay. That is what creates the FOMO. If we did not have 10 people bidding on the same home and like extending that over the hundreds of homes that are on the market every week, there's no fear of missing out because there's tons of inventory, right? So the data does line up. I mean, again, I think it depends on the data you're looking at, but the data is inventory's plummeting. There just aren't new listings, but demand is still there. And the demand's interesting at these interest rates. People are just finding more capital to buy a home, right? And whether it's through family or whatever, and this is really what's driving sort of this imbalance we're seeing. So I think the data does line up. I mean, I think it's unexpected. I'll say that. Like, I don't think people expected to see this strength from buyers with stress tests in the 7% range. And I think people expected to see more listings hit the market, and that hasn't happened, right? But definitely the housing data and the sentiment are 100% in sync.
Great. Well, I'll let you wrap up with your last segment because I know we're coming close to our end mark here.
Sure. I mean, that was it. I don't know if we have any other final questions. I don't have any other segments. I think this is.
Oh, okay. Well, bonus reading then for everybody. I really welcome you to read John's latest report. He has a very interesting story about politicians and some media, kind of fudging the question of when Canada's housing affordability crisis really ran away or started to run away. And I really invite everybody to read his latest report on movesmartly.com to look at that deep data dive, because I think it's really important as consumers and citizens that we remain very informed, because it's so easy for someone to pass the buck and say, oh, no, that happened on that other person's watch. So I really found your piece informative, John.
Yeah, thank you. And I'll probably do a video, like a separate video for our channel here, just kind of unpacking some of the trends and some of the data for those who don't get a chance to look at the report. All
right. Well, given that, I think you've answered most of the questions here. Again, we have a comment by Baltage saying with 500,000 new people and coming into Canada, and that's actually just not immigrants, but I bet PRs. Yeah, it doesn't permanent residents. It doesn't even include students and others. So the number is actually higher. I believe this year Canada saw a record 1 million entrants into the market. And they mostly come into Southern Ontario, can't figure out how a big drop can happen, at least in the GTA market. But here again, John, I'm wondering again, are we confusing long-term trends with what can happen possibly in the short term? And that's why people are not just bullish all the time.
Well, but these are longer term trends, right? Like the population boom is a longer term dynamic. And I'm going to quote, I mean, Steve actually, Soretsky kind of shared this, and it was a comment from Scotiabank's economist. And it was really interesting because, I mean, they actually argued, here's the quote, and I think it's really interesting. They said, in a broader public policy sense, Ottawa's housing strategy remains confusing. The Bank of Canada is trying to contain inflationary pressures and soften previously raging house prices. The feds have thrown open the immigration doors into a market with no supply, while another tax subsidy to housing starts up on Saturday in the form of the first-time homebuyers tax incentive. And they basically end by saying, housing is going to rip after a temporary retrenchment, and there goes the Bank of Canada's efforts. So, yeah, I mean, 100%. I mean, this is, the challenge right now is we're not building more houses than we've built over the past 20 years, like in terms of completions. Population's booming. That's either going to put pressure on house prices or rents. There's just no way around that, because you just have more people competing for fewer homes. And we're seeing that on the ground right now. So to the point and the question, yeah, I mean, it's hard to see what's going to cool the market when the demand is significantly exceeding the inventory on the market right now. I think the unfortunate thing is just going to mean wealthier people own houses. Like if we think about the trend that I talked about earlier of people who are moving out of their homes and just keeping them as rentals, I mean, that's, again, it's wealthier people who can afford that and just aren't selling them, which is actually why our home ownership rate is actually declining in Canada. Even though we've been building more homes, the home ownership is declining because people are just not selling their houses and they're renting them out.
Right. But I do point to that retrenchment. There's a lot of uncertainty around, what can happen in the short term. So there's still a lot of need to read carefully, listen to, balanced advice, and proceed carefully, because 100%. Again, we can't get confused with short term and long term. That's okay. Awesome. Well, I really thank everyone for participating in our live update, and questions are still coming in, and we keep them coming in. We'll cover them in future live updates. These happen every month, and also on other shows on our Move Smartly YouTube channel, you'll see other opportunities where these questions get addressed.
Awesome. All right, everybody, thank you so much, and we'll see you all next month.